Good morning. Well, it's morning for me. I don't know what time you might be watching this video, but hello. Welcome to the video for Chapter 1 for Survey of Accounting. I would ask that you please read the chapter prior to watching this video. The learning objectives for this chapter are now displayed on your screen. I'll let you read those. There's nothing more boring than listening to someone read information that you can read yourself. I like the title for this section of the chapter, Nature of Business. What is the nature of business? Well, the nature of business is to make money, isn't it? Well, yes, kind of, sort of, maybe. There's really more to it than that. But before we get into some of those details, we really need to talk about business types so that we're all on the same page. Our focus for this course is going to be on for-profit companies, not non-profit or not-for-profit companies. Those companies, think your local library or United Way or your church, are formed and organized in order to provide some benefit to society rather than maximizing profits. The major types of businesses are service businesses, merchandising, and manufacturing businesses. The book does a good job of describing those business types, so I'll just make a couple comments. The businesses mentioned in the book are all large national companies, but let's look at smaller companies also. In service businesses, you can think of your local hairdresser. A merchandising business might be your local hardware store. In manufacturing businesses, well, the big one we think of is AK Steel right here in our area. Businesses must decide what form or entity type they're going to take before starting business. The most common form of business in the United States is a sole proprietor or proprietorship. That's owned by, you guessed it, one person, hence the name sole proprietor. It's the most common and the easiest form of business to organize in the United States. A sole proprietor owns 100% of the business, but also 100% of the debt. The proprietor also has unlimited liability, meaning his personal assets are also available in the event of a lawsuit or other liability issues. Upside to a sole proprietor, they're in complete control. Downside, they have no one to lean on. There are small and very, very large sole proprietorships in the United States. There are some tax issues involved also, but I don't want to discuss those here in depth. That's more for a tax accounting course. Although, as a tax accountant, I would really love to get into the details of the tax situation, but I won't. Partnerships, let's think a sole proprietor on steroids. Has all the ups and downs, the goods and bads of a proprietorship, but multiplied by 2 or more people. One of my problems with partnerships is that often There are personality clashes after the business is formed, which can really cause some problems. Now, in both a proprietorship and a partnership, there is limited life for the company. If the sole proprietor chooses not to continue business for many reasons, I'm just tired of the business, I want to sell the business, I'm retiring, or I die. And in a partnership, if one of the partners chooses to not continue in the business from a legal and accounting standpoint must end and be reformed. Now, the general public may never notice that, but from the accounting and legal standpoints, it can be a bit of a problem. A corporation. We're all very familiar with corporations. And the book talks about corporations as if it is the best entity on the face of the earth. True, a corporation has means to attract money that partnerships and sole proprietorships does not have, selling stock, but you must find someone to buy that stock. Now, if you're a publicly traded corporation, that's a little different. The stock is always out there on the market to be sold. But there are many private corporations. In fact, there are corporations that are even smaller than sole proprietorships. I have some clients whose business entity type is corporation, and all it is a person sitting at a desk in their basement. But we have this conception that with the word corporation, they're big. That's not necessarily true. All these forms of business need to be able to access funds from time to time. A proprietorship has a little bit more difficult time because the perception is they're small. So generally speaking, the owner must put up their own personal collateral. Partnerships have a little better availability because there are more people. Corporations, on the other hand, because they're often viewed as large, may have an easier time at the bank getting a loan, but not always. Also in a corporation, there are a lot of, let's call it red tape involved. You must have a board of directors. You must have board meetings. You must record your minutes of those meetings. It can be a very good business type because there is protection from liability for the owners. Who are the owners of a corporation? The stockholders. You may own stock, and if you do, you're owner of a corporation. Do you fear having your personal assets attached if that corporation gets sued? No, because a corporation is its own entity. It can sue and be sued. It pays its own taxes. So there are some distinct advantages, but also some disadvantages to the corporate entity type. LLCs. LLCs are the new kid on the block. They've been around for a number of years now, but have come into great favor recently because there now is case law behind them proving that the liability is limited. The book, in my mind, does not give a good description of LLCs. Now, I will tell you things in these lectures that is not in your book, but I will not test you on anything that is not in the book. I like to provide additional information just so you have better knowledge of things. But if I say it and it's not in the book, you will not be tested on it. LLCs are really kind of cool because they can take whatever entity form that the owner needs. A single member, and they're called members, not partners, a single member LLC by default files and pays taxes and operates its business as a sole proprietor. A multi-member LLC by default files and pays taxes and operates its business as a partnership. But either one of those can take a corporate election, file and pay taxes as a corporation, and act as a corporation. The neat thing in my mind about this is that the business can grow and change and contract and change as needed without having to close down the business from a legal and accounting standpoint and reform. So a limited liability company has really come into favor. In fact, my business started as a sole proprietor. About 5-6 years ago now, I changed to an LLC and then took the corporate election. Lots of reasons for all of that, but just to show you that many of us who have operated as one entity type have now changed to LLCs. Here's a listing of some of the differences in the forms of business. And please note that the line with limited liability company is strictly as it defaults to. This entity can make elections, they're called, so that they can operate in different ways. How does a business make money? Well, they sell things for more than they buy those things for. That's the down and dirty. This particular section kind of makes me laugh. Well, duh. They want to make more money than they spend. Give me a break here. There are 2 strategies listed, although there's many strategies that companies can choose to operate as. The 2 that are mentioned are, of course, the low-cost strategy, think Walmart, buy cheap, sell cheap, and the premium price strategy, think BMW. I mean, it's a vehicle, 4 wheels and a steering wheel. But are we willing to spend a lot of money for a BMW? Absolutely, because we believe it to be a much better vehicle. What is it the commercial says? It's the ultimate driving machine. So our perception is that it's a great vehicle, so we're willing to pay more money for it. Here's a couple of examples of that low-cost and premium price strategy. Now remember, there are many variations of strategies between low-cost and premium price. This is just an example. Stakeholders. What are stakeholders? Okay, the down and dirty version. A stakeholder is anyone or thing impacted by the business in any way. The municipality or town in which the business is located is a stakeholder. Employees are stakeholders. Vendors are stakeholders. Neighbors living in the surrounding area are stakeholders. I think you get the point here. And just another example of stakeholders. Businesses have three distinct areas of activities: financing, investing, and operating. All three are of vital importance to the company, and how they handle those activities will determine the success or failure of the company. The investing activities include buying assets. Assets are things the business owns that it uses in the business. So buying assets to do what it is they do. Machinery, equipment, plants, buildings, vehicles, all those things. And that includes what are called intangible assets, things that you cannot touch. Patents, franchise agreements, those sorts of things. Operating activities are what we're in business to do, and financing activities is how a business obtains funds. Sorry, I want to go back to this for a little bit. Financing is one of the most important parts of a business. A business cannot operate without money. Many new startup businesses, and I think in my lecture notes I referenced 99.9%, which is not a scientific number at all. New businesses, startups, entrepreneurs have to obtain funds by begging, borrowing from friends and family. Anybody willing to lend money, because they have no track record, they have no credit history to obtain funding from a bank. That's called bootstrapping. In order to get money from the bank, they must use collateral, if they have any, perhaps their own home, something of that nature, in order to get a loan. But financing activity is very important. There are two types of financing. One is called debt financing, borrowing from a third party, the bank, your grandmother, your great Aunt Sally, money that you must pay back. The other is called equity financing, and that's from someone investing and becoming an owner of the business. Now, throughout this book, we're going to talk about business as a corporation. So, equity financing in a corporation is selling stock. Finally, we're getting to the part that I absolutely love. Accounting takes all the stuff of the business, all the transactions, and organizes it into a form that allows us to read the story of the business or see the picture of the business. It's not about math. Yes, there's some limited math involved, but it's about knowing the story. It's about putting the puzzle together, how it all fits. Our goal is to take all that stuff, all the receipts, all the checks we write, all the deposits we make, all the merchandise we purchase and sell, and put it into a form that we can prepare financial statements. Financial statements are what tell the story. Now, the book tells us that accounting is the language of business. And isn't that what I've just said? We read the story, and we need a language in order to read the story. Financial statements are the synopsis of that story. There are objectives of financial accounting. We want to report the financial condition over a period of time. That's our operations. And we want to report our financial condition at a particular point in time. Now, we're going to talk about financial statements, but before we do, let's talk a little bit about where the information for financial statements come from. It's a little confusing when you first step into accounting to understand how it is all put together. There are 4 major financial statements. You can read those on your screen. But what are they and where do they come from? So we have to understand the various pieces of the puzzle. Now, go back to your own life. Have you ever prepared a budget? You know, expenses by category, your food, your clothes, your rent, and what you have coming in from your paycheck? You've just prepared an income statement. We need to categorize things so that we can see where the various pieces of the puzzle are. Now, let's talk about some terms that you may not be familiar with. Assets are things the company owns. A company owns its cash, its accounts receivable, its inventory, its equipment. Liabilities are things the company owes. I owe my accounts payable. I owe the mortgage on the building. I owe the payroll taxes I've withheld from my employees. Those are things the company owes. Both of those items are shown on what is called the balance sheet. Sometimes I refer to that as the statement of BS. I hope you get a chuckle out of that. Revenue is the money generated from what the business is in business to do. For you personally, revenue would be your paycheck. For the business, it is the money it brings in from selling either its services or its products. Revenue does not include money borrowed from the bank. I didn't sell anything to get that money. So revenue is strictly the money brought in from doing what I do in business. Expenses, as we talked earlier, are those things that we need to pay in order to run our business. Just like in your own life, the business must pay rent and utilities and insurance, those kinds of things. Expenses do not include loan payments for the same reason that revenue does not include money borrowed. An income statement reports the changes in a company over a period of time. I've earned this much revenue, I've got this much expenses, and I have this much in profit or loss. The net profit or loss is carried to the statement of retained earnings. We haven't talked about that. Stockholders' equity, owner's equity. How to explain that? Have you ever talked about or heard someone say, I have this much equity in my house? Equity is the difference between what is owned and what is owed. So if I own my house and it's worth $100,000 and my loan, my mortgage is for $50,000, I have $50,000 in equity. It's kind of similar to a business. Equity can be increased by profit, by selling additional stock. It can be decreased by dividends and by losses in the company. So the net profit from the income statement is carried to the retained earnings statement. The ending retained earnings is carried to the balance sheet where the assets and liabilities are listed, along with the equity in the company. Both together, the asset plus the liabilities and equity must balance. We'll talk about that a little bit more. As part of your homework, you will be preparing financial statements and looking at how these statements fit together. Here is an income statement for the Hershey Company. Every time I see this, I want to go eat chocolate. All right, revenue. You see in their first line, they list their sales. And notice this is in millions of dollars. I just can't wrap my head around that many zeros. And then they list their expenses and come up with their net income, which means that they had more in sales than they did in expenses. Now, an income statement is for a period of time, an accounting period, 1 month, 1 quarter, 1 year. This shows the changes in the financial condition of the company because of its operations. And it uses the matching concept, which at this point is going to make absolutely no sense, but we'll talk about it and you'll see how that plays as we go further. Here's an example of the retained earnings statement for the Hershey Company. Now look, okay, we have our beginning retained earnings. Second line says add net income, 661. Let's go back up a page. Do you see? Net income, 661. So we're bringing that amount to our statement of retained earnings. We then subtract any dividends. We have our net of those two numbers, and we find our retained earnings for the ending of the period. Retained earnings is the profit retained in the company. Now, if you go back and look at your income statement, you see that we had net income of $661. Well, owners of the company don't buy stock simply because they like the company. They buy stock because they expect to get a return. They expect to get something for being an owner of the company. That's what dividends are. The company is taking some of its profits and giving it to the owners of the company. Retained earnings is what we've kept in. So if you look at this statement, we had net income of $661. We paid $341 million, I believe, to our stockholders, and we kept $320 in the company in order to build buildings, buy new equipment. It's profits that is retained. This is an example of the balance sheet. You see the assets are listed first, the liabilities are second, and the stockholders' equity is third. Now let's look at this in a little more in depth. Look at total assets. Do you see The double line under total assets indicating a total. We'll look under total liabilities. We don't see that. But we do see it at the very bottom of this page where it says total liabilities and stockholders' equity. That's because on the balance sheet, assets equal liabilities plus stockholders' equity. And it's called a balance sheet because it must balance. Total assets must be the same number as total liabilities and stockholder equity. Take a few minutes to look at this. You see at the bottom, assets equals liability plus stockholders' equity. That's the accounting equation, and we will use that throughout the rest of this book. I'll let you read through how to prepare a balance sheet. This is also listed on page 13 of your textbook. The fourth financial statement is the statement of cash flows. Everything we've looked at so far is looking at the profit of the company. Profit and cash are two different things. A company can make a profit and still have no cash, depending on how many loans they have outstanding. That's called, a company in that position is usually called heavily leveraged, meaning they owe a lot of money. It is of vital importance for a company to be on top of its cash, to know where its cash is coming from and where it's going to, or its inflows and outflows. Without that, a company can actually be very profitable and still yet go bankrupt if their cash is not controlled. Now, we talked early on about three activities of a company: operating, investing, and financing. And you can see that this statement of cash flows is divided into those areas. This particular piece, or this particular financial statement, comes directly from our bank account and other cash and near cash accounts. On the statement of cash flows, our operating activities are reported first. Why? Stakeholders want to know what you're doing in operations, because that determines whether the company is successful or not. Investing activities is reported second. I know, you can read that. And as we talked before, this comes from buying and selling of property, plant, and equipment. Generally speaking, this section will always be a net cash outflow, because when we sell our equipment, it has become obsolete or useless and is not worth very much. Buying new equipment is very expensive. The third section is our financing activities. Have we received new loans or paid down loans? Have we sold stock or bought back stock? Have we paid dividends? All those areas are listed in this section. This shows you how the financial statements are related. Gives you a visual representation of that. I like watching it draw little red circles. And as we've talked, this is how they're integrated. Accounting concepts. This is important, and your understanding of these concepts will help you as we move forward. The accounting concepts are called Generally Accepted Accounting Principles, better known as GAAP. And no, we're not referring to the clothing store. The Financial Accounting Standards Board, FASB, has the responsibility for developing these accounting concepts. The SEC also has some authority over that, and we'll talk more about that as we move forward. Let's talk about our concepts. Business entity concept. The business entity concept says that the economic data recorded is for the business only. It's separate from its owner, the business. Even though we know from what we talked about in the very beginning that in a sole proprietor and a partnership, the owners are the business. In terms of recording the transaction of the business, we are only recording business transactions. We don't intermingle personal transactions in that. The cost concept. That means we record our transactions at cost or purchase price. We don't record our transactions at what we believe to be the value, because that might be different than the cost or purchase price. Example, I bought a car from, I don't know, who did I buy a car from? Grandma Goldie, how's that? Bought a car from Grandma Goldie for the business. I paid her $5,000 for it, but the car was actually worth $15,000. Based on the cost concept, I will enter the cost of that vehicle in my books as $5,000, the dollar amount I paid, not what I believe the value to be. Going concern. This simply states that the business will continue in business indefinitely, unlike a yard sale. Although I'm sure all of you have seen those yard sales that seem to last quite a long time. Matching concept. Matching concept states that revenues will be recorded when earned and expenses when incurred. Now this is where the cash and net income sometimes go down different paths. And I know this isn't going to make a lot of sense right at this moment, but we will see how it works. Sometimes a company sells something and does not get paid immediately for it. Might be a month or two later. Accounts receivable. See the difference between revenue and cash? Sometimes a company may buy something and not pay for it. I buy a product. I don't pay for that product until next month, but I may have sold it this month. So the matching concept says we're going to record revenue when earned, whether paid for or not, and expenses when incurred, whether paid for or not. Objectivity concept. Our entries, our accounting records must be based on objective evidence. We can't just reach into the magician's hat and pull out numbers. We need invoices, bank statements, deposit records, anything objective. Unit of measure. Our entries will be recorded in the currency of the country in which we are in. Okay, in other words, we use dollars and cents in our accounting records, not euros or pesos or whatever else is out there these days. Adequate disclosure. Sometimes the numbers alone do not tell the story, so we will provide whatever is necessary to fully describe what we're trying to get across. Accounting period concept says that we will have specific periods of time on our financial statement. We're not going to say, okay, this financial statement is for the last 432 days. We use specific periods of time. Remember these concepts. They will help you as we move forward. There's been a lot of fraud, a lot of unethical conduct in the accounting world, particularly in the last 20 years or so. The main reason that we do all the bookkeeping and accounting work necessary to provide financial statements is so that those financial statements are accurate, timely, and usable. And all too often, companies have prepared inaccurate financial statements in order to make themselves look better in the eyes of stockholders or investors or whomever. But that's fraud, and they get caught. And as we move forward, we will learn about some things that have been put into place so that this fraud, well, we can't make it not happen, but we can make it less likely to happen. Ethical conduct. You know, and ethics are very difficult to talk about because we all have our own take on what is ethical. But you need to remember that in the business world, you must make decisions sometimes decisions to leave a company because their ethics are not up to your standards. But you have to be very aware of the ethics around accounting areas. Throughout the book, we're also going to learn how to analyze financial statements. As I mentioned, financial statements need to be accurate, timely, and usable. That usable is important. What is the point of doing all the work and preparing the financial statements if all we do is file them on a shelf or in a drawer? We must use them. They tell us the story of the company, and from that, we can help determine the future of the company. So the first one we're going to look at is rate of return on assets. It's a measure of our profitability. The way it is calculated is net income. Remember where that comes from, the income statement, before taxes and interest expense. So you may need to add a couple numbers back to net income. Divided by average total assets. Assets at the beginning of the period plus assets at the end of the period divided by 2. expressed as a percentage. Now, this rate of return is not some specific number that all companies must strive to reach. It is different for every company and every industry. You must always take these ratios in context with the company or industry that they are attached to. A company like AK Steel has a lot of assets. A company like Google has very few assets, hard assets. So remember that. Here is an example of how to calculate and what we're looking at. Apple and Dell, both computer companies, and both with very different rate of return on assets. Again, these are just numbers. We need to know the story behind the number. Now, this says that Apple is 3.8 times more profitable than Dell. Not necessarily. We still need to go behind the numbers to understand them. And that is the end of Chapter 1. I hope you've enjoyed this lecture, and if I can improve these in any way, please let me know.